Tonight, the session's not targeted on a specific task in the exam. This is more about a topic. And the topic we're covering is material and labour variances. We'll be coming back to this in future sessions where we will look at specific exam type questions and the kind of way they are presented. And there are refinements, if you like, about variances. But this is a topic that many people do find challenging. Over the many years I've taught AAT, I've had as many questions on variances as on any topic that I can think of. So without further ado, let's make a start. And we're going to talk about material and labour variances. There are other variances, but primarily the ones we start with are material and labour. How much material should go into a product, and how long should it take to make it, and what should our cost be. Our point of reference always to start with is a thing called a standard cost card, and the cost card is the thing that we measure against. And often in an exam question, you may well not be given a cost card. You may be given data about what the budgeted activity was expected to be, and if that's where you started from, then step number one is always to draw up your own cost card. But for tonight's introductory session, I've done as a cost card, and the cost card, as its name suggests, details what we expect it will cost us to make the product. Why do we need to know that? Well, we can use the information for a number of purposes. A couple of obvious ones: planning resource requirements. If we know that we are going to produce 100,000 units and we need 2 kilos of material for each unit, we know that we need to have orders in place with our supply chain for 200,000 kilos of material over whatever the time frame the budget is. It's fairly obvious, but again, without knowing what's going into every unit as well as how many, we need it as a starting point. The other thing is, we need to know what it costs us to make a product to set a selling price. Many years ago, I had a granddad who was a furrier, which is a trade which nowadays nobody is, but 50, 60 years ago, it was a different world. And he ran a shop, and he used to sell hats for £5, and he didn't have a clue how much it cost him to make them. And no surprise, really, the shop didn't really do very well. So your starting point in any business is you've got to know what it costs you to make your product before you know how much you can sell it for. And in the modern world, where there's a lot of competition, there's a lot of businesses fighting for not many customers in a lot of areas. In many cases, the business will look at the existing products. Let's say you want to go into business selling televisions. So you look online and you say, well, the one we can make, other people are selling for £399. So you actually need your cost card to see if you can actually make it much cheaper than that, to even make it worth making in the first place. So the cost card is very much a building block that a lot of our activity is based on. Having said that, we start at the beginning with the cost card of what we think our product costs to make. Real life has something of a habit of being different to the theory. So what we're able to do after a period of time is look what's really happening in comparison with what we expected. And again, if we've made 20,000 units, we look at the cost card that says we should have used half an hour per unit. Did we use 20,000 times half an hour, 10,000 hours? Did it take longer? Did it take less time in labour? Did we use more material? Did we use less? And again, without the cost card as something to measure against, we really have nowhere to start. When we get a difference, well, why might it happen? First thought, market price of materials may have altered. And that can happen both ways. There could be a shortage or there could be a surplus. At the minute, everybody's talking about energy. There is something of a shortage of gas on the wholesale market. So as we're all sadly finding out, the price of gas is rising. Other times that are popular, if you get asked a question in an exam, give examples of things that can cause a price variance. You could have had a really good coffee bean harvest down in Colombia or Nicaragua or Kenya or wherever you're importing your coffee beans from. If it's been a really good harvest, then the price will go down. So, you know, things happen in the real world that can affect what we're paying for goods. That's materials. When it comes to labour, we may be working more or less efficiently than expected. It may be that a competitor has poached some of our best operatives from the factory floor and we've had to get new people in to train up. It's taken them a lot longer to make our product. We may have got somebody in there who's had a really good idea for a really neat way to organise things, and we may be working quicker than expected. Again, it can go both ways. And here's a fallback answer. If ever you have a question that says, suggest reasons for the variances that you've observed. Standard fallback, if you can't think of anything else, whoever drew up the cost card in the first place might have done a bit of a rubbish job. They may not have particularly accurately estimated. So that's always a good fallback answer if you can't think of anything a bit more interesting. Okay, well let's look at the mechanics of it. So typical assessment task, we're given expected results and actual results. And the difference between the two is a variance. Variances come into two categories. I appreciate a lot of this is quite fundamental, but we will get into it a bit more in a couple of minutes. Variance can be favourable, which is better than expected. And an important word there is better. Don't think of variances as more or less, because if you're looking at your sales revenue, then more is better. So that's favourable. If you're looking at the cost of wheat to put into your bread loaves, then less is better. So favourable means better. If it's profit, more is better. If it's cost, less is better. Or it can be adverse, which is worse than expected. Do watch out for instructions if you're given a computational task. Sometimes you will be told, show an adverse variance as negative, or you may not. Traditionally, they were just given as absolute figures with an F for favourable and an A for adverse to distinguish. So favourable variances typically indicate lower cost and therefore increased profit in the short term, and I've put an asterisk there, which we'll come back to. Adverse variances indicate higher cost or lower revenue, therefore reduced profit, and more on favourable variances later. Mystery, keep you interested. Everybody with me so far? Do shout up in the chat box if I go too quick or if I mumble my words and you can't hear me. A hint. Oh, I just really repeat what you just said. If it's a cost, less is better. If it's income or profit, more is better. So the words to use, you do your calculation before you even work out the figure. Say to yourself, is this good news or bad news? Let your common sense kick in here. Well, we thought we'd spend £12,000, we spent 14,000. This is bad news. So immediately, bad news, it's adverse. Then work out, then tap the numbers in your calculator, work it out. But use your common sense. I've seen a lot of times people will get a column of figures on the left and a column of figures on the right, and it's like, well, if the left's higher, is that adverse, or is it if the right's higher? Don't look at it in terms of left and right. Is it good news? Is it bad news? Much safer, much safer. It sounds obvious, but I've seen that many times that you've got income, then you've got material cost, labour cost. And if all the left-hand ones are higher, they're all flagged as being favourable or flagged as adverse because they go the other way. So use common sense, make it real life. So we calculate variances using actual costs and a thing called a flexed budget. What that simply means is, if we've produced a different amount of our product, then it's going to have a different amount of inputs. If your factory manager is targeted with producing 10,000 units, and that should use £20,000 worth of a particular material, if everything runs efficiently and he manages to produce 12,000 units, you wouldn't give him a hard time for using 10 or 15% more material. He's actually used less material than you would expect for 12,000 units. So we flex our budget in line with what we expect that amount of product to need. Again, it's common sense. We recalculate our expected costs in line with output. So if our output is £100,000 for 10,000 units, 12,000 units, we'd expect £120,000. And that's what we compare against, not the original budget, but our flexed budget. We call that flexing. So if 10,000 units should require 5,000 kilos, 12,000 units, we'd expect to use 6,000. You know, if our factory manager actually used 5,500, you wouldn't say, well, we budgeted for you to use 5,000. How have you wasted it? You know, we'd say, well done, you've produced a lot more units and you've used less material than expected, which might be good news, but we'll come back to that. The other reason that a difference in cost can come about, the price can change. We've said, you know, there might be a brilliant coffee harvest. There might be, of course, there was that container ship, wasn't there, that got stuck in the Suez a few months back. Loads of goods went up in price. What else has made things go up in price? For many years, the UK has shipped literally boatloads of waste off to China for disposal. So all of those lovely Chinese things that come over in containers that we all buy on Amazon, garden lights, microphones, webcams, laptops, keyboards, oh dear. All of those things, we would pay one lot of shipping one way, but then the same container would be full of waste and sent back. And that meant that the cost of shipping those goods in was reduced because the shipping company were getting paid both ways. If it's our government's wisdom or the Chinese, that deal has ended and we are no longer shipping boatloads of our waste over to China for disposal, which means that the containers are coming in full of techie goodies, but going back empty in many cases. So the cost of shipping from China has recently increased. So loads of items, if your product relies on components that you're buying from China, you're now paying a higher price. There's a great real world example of just that's happened within the last few months. The other thing that's affect prices, the thing we'll not talk about tonight, since it's nearly over, but that's affected a lot of supply chain issues and prices. So ask two questions. How much material, this is for material variances. The first question says, how much material should we use for this many units? And if this many units is half as many again as the budget, then it's half as much again as the budget. But how much in quantity, we're saying here, not how much should it cost, how much material in kilos or litres should we use for this many units, question one. And we compare that with the actual amount used. So if we expect for this number of units to need 20,000 kilos, if we actually use 20,500, that's 500 extra kilos of bad news. We multiply that by the standard cost. We're not interested in what we actually paid for it at this stage. We deal only with the amount of material different for our usage variance. Second question, how much should we pay for this amount of material? Notice, again, not the budgeted amount, but the amount of material we bought. If we bought 12,000 kilos, how much should we pay for 12,000 kilos? Compare with the actual amount, that's your price variance. Now, a worked example. Product A requires 5 kilos of material per unit, and 1 kilo should cost £14. We expected to produce 10,000 units, we actually made 10,500. And we actually used 52,000 kilos of material at a cost of £780,000. We can lay out workings like this. 10,500 units at 5 kilos a unit should need 52,500 kilos. That's our standard usage. We actually used 52,000 kilos. We've saved 500 kilos. We would expect that for that amount of product. So this is good news. At £14 a kilo, we've saved £7,000. £7,000 worth of good news. A favourable usage variance of £7,000. Next, we look at the price variance. 52,000 kilos, which is how much we have bought, should cost £14 a kilo, which is £728,000. We actually spent £754,000. That's our actual cost. Immediately, I'm thinking bad news. An extra £26,000 is an adverse price variance of £26,000. Perhaps the reason we used less was we got better quality material, so the wastage was less. But plainly, we've spent a great deal more. The last exercise that we do with our material variances is we reconcile them, and this is one way of making sure that we've not keyed a figure wrong. It's a good safety check. We're going to compare what the units produced should have cost with the actual cost. Standard cost for 10,500 units times 5 kilos at £14 is £735,000. That isn't what our budget said, because we've made more. We've flexed it. We saved £7,000 because we know that we used less than we would normally use for that many units. Our adverse price variance, 26,000, we know that we paid more for the material that we did buy. We actually paid 754,000. If we do 735, take off 7, gives 728 at 26, sure enough, that less that plus that comes to what we actually paid. Do that in an exam, even if they don't ask you to reconcile against the total variance. It does give you a little bit of a comfort factor that the chances are you got it right. And it just protects. It's so easy to hit a button wrong on your calculator. Labour variances follow a very similar logic. 2 questions. How many hours should it take to make this many units? The actual units we've made, not what the budget said, to make the number we've actually made. Compare that with the actual number of hours worked. And again, we multiply by standard hourly rate. That gives us our efficiency variance. Standard hourly rate, much the same as the material multiplied by the standard cost. Now we use the standard rate. Secondly, how much should we pay for the number of hours that were actually worked? Again, not the budgeted figure. We're looking at how much did we expect to pay for that many hours? What did we actually pay? And that's our rate variance. Product requires an hour and a half per unit. We're paying £16 at standard hourly rate. 10,500 units. We actually work 14,200 hours and we paid 248,500. This time, 10,500 at 1.5 hours, we should need 15,750 hours. That's our standard time. We actually worked 14,200 hours. That's the actual time taken. Immediately, I'm thinking good news here. We've saved 1,550 hours, which at £16 standard rate, saving in time has saved us £24,800. Favourable variance because it's good news. 14,200 hours, the hours we've actually worked, should cost us £227,200. We actually spent £248,500. So in this case, that's £21,300 more than the standard cost for that number of hours. plainly that's bad news. So it's an adverse variance. And again, we can reconcile. 10,500 units should cost £252,000. We saved 24,800 on efficiency, but we paid 26,000 extra on rate. Which again, 252 less 24 plus 26 takes us to the actual amount paid, which was 248,500. I've got a typo in the figure there. But you get the principle. Now, the mechanics, one thing. The other thing that we tend to get asked about in an assessment is a favourable variance good news? Is it always good news? And this is the thing I hinted at earlier on. Because it stands to reason, if you expect something to cost a certain amount and you get it cheaper, well, surely that's got to be good news. Up to a point, this is true. If there's a perfectly good reason for it, maybe you've bought the usual material more cheaply because you've negotiated a really good bulk discount. Your supplier perhaps has over-ordered. It says you can take 3 times your normal quantity. I'll knock you so much off the price. Great. And I said it with the example of the coffee beans. If it's food related, there might be a really good harvest. So if there's a perfectly good reason, then yeah, it's going to be good news. It's got to be. With labour, somebody might have found a way of working more efficiently. They're not wasting as much time. So that's something that maybe you could pass on to other people. So it is possible. There is a but. There's a but. It could be that the quality of the product has been compromised. So whereas an adverse variance has always cost you more than it should, so it's always bad news, a favourable variance can be good news, but if you have compromised the quality of your product, that may not be a big deal, but it can be indeed. So let's say you're a paint manufacturer churning out sort of 1 litre tins of gloss paint for people to paint their houses with. Somebody buys a tin, when they start putting it on, wow, this is nothing like the picture in the catalogue. This is nothing like the label. Doesn't go with the curtains at all. Dreadful. So you're going to get a bad review. They might even take it back, play up at the shop, and then you've got to give refunds. Not good. What if your machines are calibrated wrong and you're finding that you are getting favourable usage variances on all your ingredients because, in fact, you're not putting as much in the tin as you're supposed to? So you're selling 1 litre tins of paint with 990 cc's in. And if trading standards, weights and measures we used to call them, if they find out, you might get slapped with a fine and more bad publicity. So it's bad news, but that's not going to really, not the end of the world. But it could be a lot more serious. Now, here is a big lump of metal. In fact, it's several pieces of metal, and those knobbly things are rivets that hold the plates of metal together. They're like a sandwich like that, and the rivets get hammered in, hold it together. And there is a point to this. If you had your cameras on, I'm sure there'd be some positive looks, but there is a point. Let's have a quick lesson in metallurgy, and it will only be a few seconds. Steel plates held together by rivets. Rivets are graded in quality. A grade A rivet, once it's held together, those panels can be hit with quite considerable force, and the rivet will hold. It might even sort of deform slightly, but it will hold. A grade E rivet, on the other hand, is much more brittle, and if you give it a good whack, chances are the rivet is far more likely to snap. So, rivet quality grade A is the best, E is the worst. The design specification, I've said good quality rivets can cope with a bit of hammer, bad ones will snap. This particular item we're looking at, the design specification called for rivets of grade B or higher. So A or B would do, nothing worse. This was quite a long time ago. This is a true story. Communication being what it is in Chinese whispers, maybe by accident, or maybe somebody was trying to save a couple of bob. Some grade D. Now B and D do sound quite similar. D rivets were delivered. And the bad news is they got used anyway. So you've got these metal plates that should have been held together by grade B rivets were held by grade D rivets. One or two folk might even guess where this is going. This is actually a piece of the hull of a well-known ship that was recovered. It should have been strong enough to withstand quite an impact, such as a scrape from an iceberg. I think everybody guessed where this is going now. And this is a true story. It's quite a popular theory. The theory is that a number of the rivets snapped, the plates separated, which is why something that should have been survivable resulted in the end of the Titanic. And you probably know that's a story that's gone on for well over 100 years now. And that is a very popular theory, that a favourable price, presumably those rivets were cheaper because they were grade D and not grade B, so they will have come in cheaper. So a favourable price variance may well have been responsible for sinking the Titanic, in conjunction obviously with a rather large iceberg. So the serious point is, favourable variances, it's not a case of, oh great, we made a bit more money, woohoo. There can be a downside to it. So is it always good news? The answer is no, not necessarily. A true story. So what do we do about variances? Okay, this is something you may well get asked in an assessment. And tonight's objective isn't really to look at exam questions, just to be putting you in the right mindset. So one thing we're asked is a variance significant or not? And thankfully exam questions are a bit more straightforward than real life situations. And they'll say to you, if it's 5% of the standard cost, then it's over that, it's significant, and you've got to flag it up to report it to whichever manager. And if it's less than that, then it's not, and you don't. Popular error, make sure you always calculate variance divided by the standard cost, not the actual. So if something should be 10,000, the variance is perhaps 5,500, giving an actual of, sorry, if the variance is 500, so that is 5% of 10,000. But if you compare that to 10,500, you get less than 5%. So popular error is to measure against the actual and get a lower percentage. Easily done. So it's variance over standard. In the real world, it is a bit more complicated. Like we've given one example there. Generally speaking, in the real world, there will be exception reporting. You know, variances do have to be significant because, you know, a fiver in £100,000, management aren't generally going to want to spend a lot of time and money investigating for something as trivial as that. But there are exceptions. Exception number one, in your business, there's a certain process that takes place. Maybe it's highly automated, you know, stuff goes in, robots do this, now that kind of stuff. And it's always perfect, and it's been perfect for as long as anybody can remember. Then all of a sudden, there's maybe a 0.3% variance on something. It may well be that would be investigated because it might be a sign that something is about to break in a big way. Because often, you know, you get little early warning signs, rather like little rumbles of thunder many miles away before you end up with a big deluge, sort of 25, 30 minutes later. So if it's something that's never, ever given a variance, but does now, then maybe you will. What if the item's valuable? What if you work at the Royal Mint and you are, work at the Royal Mint, printing £20 notes, a bundle of 500 out, the print run of 1,000,000 £20 notes goes missing. I think that's probably people are going to be bothered about that. Or maybe you're working in like a diamond cutting workshop, cutting diamonds into jewels. Again, a gram or two of diamonds out of a big consignment is certainly going to be investigated because of the value. And the last one is a bit scary. If you work at a nuclear power station and a bit of nuclear waste, it does not have to be 5% missing before we worry about it. A very small amount of nuclear waste could end up being a very large amount of either explosion or poison. So sometimes in the real world, we are a lot keener to investigate a variance than we would be just in an assessment question. And particularly, we've already had the talk about the Titanic. Anything that's safety critical, you can have modern aeroplanes are immense things, these gigantic streamliner things. One washer missing off of one of those could bring the whole thing down. So again, if you are manufacturing in a safety critical environment, then the tiniest variance may well get investigated. So last topic coming up. So what do we do about variances? Assuming we decide that a variance needs to be investigated, really we're faced with two possibilities. The first one, is it a one-off? We've said about the pandemic has put so many, any business that involves customers coming into the premises in a terrible spot. Where all pubs have had a hammering, a lot of shops have a hammering. So hopefully that's not going to happen too often. Or you get cases of a lorry crashing into the shop front. So, you've got to put the shutters up and close the shop for 3 months. Something like that, that's a one-off, you're not really going to do much about for the future because it's not going to happen again. Maybe, I don't know, maybe there's a big incident on the shop floor one day. So if it's a one-off, then there's no real action we can take or would take. But if it's a result of a permanent change, so the cost of a raw material has gone up and will not come down again, then we are going to look at our standard cost card and we're going to rework the standard cost card. So if we find that 3 months in a row we've used 5% more material in volume than we expected, we'll go back and rewrite the standard cost, and we'll for future be expecting to use a greater amount of material, because now we know our product is more expensive to make. It might be that'll feed through to a change in the price. So if it's a one-off, it's just one of those things, we do nothing. Whereas it tells us that something has changed. Minimum wage rate, every so often the government reviews the national minimum wage, and if that goes up, then a lot of industries will have to reflect that in their standard costs, because that's a permanent change. Okay. At that point, that concludes the scripted part of what I had to say tonight. So I will at that stage stop the recording.